A toll road is a straightforward asset. It is a physical stretch of concrete and steel and generates cash every time a vehicle passes through. But the legal ownership of these physical assets is rarely that simple. The revenue collected at those gates is pulled upward through a complex hierarchy of holding companies, subsidiaries, and corporate structures before it ever reaches an investor. That brings us to the Citius Transnet Investment Trust. They are bringing an 11.05 billion rupee initial public offering to the market. This entity is structured as an infrastructure investment trust, or InvIT. It does not function like a standard corporate stock. It is a highly specialized container designed entirely around yield distribution. Taking raw physical infrastructure and converting its revenue into a regulated, publicly tradable financial product requires a high degree of structural engineering. The public markets require strict compliance, asset isolation, and specialized governance. The official filing submitted to SEBI reveals the blueprint. The sheer density of defined terms shows the complexity of the trust's architecture, relying on deliberate mechanisms to pull value upward from the asphalt level directly into the hands of unit holders. To determine the actual value of these public units, we have to reconstruct the entity from the bottom up. We need to carefully map exactly how the money moves. Without understanding the underlying pipes and legal wiring, investors have no visibility into who truly controls the cash flow or how the risk is distributed across the portfolio. The foundation of this entire structure rests on a concept called the Special Purpose Vehicle, or Project SPV. Looking at the trust's base, the physical toll roads are not lumped together. The portfolio isolates the roads into 10 separate legal entities. Above these isolated projects sits an intermediary layer. The SPVs are consolidated under larger holding companies designed to aggregate the assets. In this specific transaction, those holding companies are EPIC 3 and SRPL. They function as the primary aggregation points for the underlying tollways. Collectively, this bottom tier of holding companies and project SPVs makes up what the filing refers to as the initial portfolio assets. By isolating each road into its own SPV, a catastrophic liability at one toll plaza cannot easily infect the adjacent projects. The risk is siloed before the profits are centralized. At the very top of this hierarchy sits the Citius Transnet Investment Trust. This is the container that will ultimately issue units to the public. Because Citius is registered as an irrevocable trust, it cannot execute business operations on its own. It requires a grid of specialized external actors to function. First is the sponsor, EPIC Transnet. This is the entity responsible for setting up the trust and initiating the transfer of the assets. Next is the trustee, Axis. They act as the legal custodian. Their sole function is to hold the physical and financial assets securely for the benefit of the unit holders. Capital allocation and strategic decisions are handled by a third party, the investment manager, EAA. Finally, a distinct project manager is assigned to handle the physical reality of the roads, the daily operations, the maintenance, and the toll collections. This fragmentation is intentional. By separating legal ownership from strategic capital management and physical road maintenance, the structure is designed to limit internal conflicts of interest. We have the bottom layer assets and the top layer container. The question is how the value actually bridges the gap between the two. This is achieved through the formation transactions. Before the public offering occurs, an intricate sequence of legal plumbing connects the base to the master trust. The first mechanism relies on securities purchase agreements. These SPAs transfer direct equity value from the holding companies upward into the trust. But equity is only half the equation. The trust also uses debenture transfer agreements to acquire the non-convertible debt obligations held by the asset tier. These debt transfers execute under two strict legal parameters: DTAs executed for cash consideration and those executed via swap consideration. We can see this in the text. The offer document explicitly lists out the specific project SPVs governed by the cash consideration logic and those governed by the swap consideration logic. Finally, deeds of assignment are executed. This third mechanism specifically reassigns existing intercorporate deposits and loans directly to the trust level. SPAs, DTAs, and deeds of assignment run simultaneously. They clear out the fragmented balance sheets below and pull all equity and debt up into the central container. Without these precise formation transactions executing successfully, the master trust remains an empty shell, with zero legal claim to the cash generated at the toll gates. Once the assets are legally locked inside the architecture, the trust is cleared to offer units to public investors. This visualization shows the capital allocation mandated by SEBI for the 11.05 billion rupee raise. The issue is strictly divided, a maximum of 75% for institutional investors and a minimum of 25% for non-institutional investors. Within that 75% institutional slice, the investment manager can carve out up to 60% specifically on a discretionary basis for anchor investors. The text outlines the rigid mechanics of the bid. Every bidder outside of that anchor group is required to use the ASBA protocol, meaning their bid amounts are completely locked and blocked by their banks upon application. The book-building process leverages these blocked funds and institutional commitments to discover the final unit price. This split hierarchy serves a dual purpose. It relies on massive institutional capital to establish accurate price discovery, while legally guaranteeing a 25% floor for retail participants. The IPO mechanics explain how the current portfolio is monetized, but a static portfolio of aging roads eventually degrades. To prevent stagnation, the documentation includes a right of first offer, or ROFO agreement. The ROFO legally binds the sponsor group. When they develop or acquire new eligible infrastructure projects, they are obligated to offer those assets to the trust before shopping them to the open market. The filing already lists a pipeline of identified ROFO assets. This acts as a pre-built reservoir of future roads waiting to be absorbed into the main architecture. This mechanism is what gives the InvIT its longevity. It continuously cycles newly developed projects into the portfolio to replace depreciating assets and sustain the overall yield. But financial engineering cannot simply override market reality. An established architecture can still come to an abrupt stop. The sponsor includes a specific warning in the text regarding the nature of this initial public offering. Because this is a first-time issue for the trust, there is zero historical trading data. The valuation models are entirely theoretical until the market opens. The explicit disclaimer in the document leaves no room for misinterpretation. The structural guarantees end at the trust level. The value of the units and the income derived from the underlying roads can fall just as easily as they rise. The trust effectively shields investors from individual project liabilities and secures the cash flow from the toll plazas. But once those units are listed, the final liquidity and the ultimate yield belong entirely to the volatility of the open market.
हमारे सभी सोशल मीडिया अकाउंट्स की लिंक पिन कमेंट और डिस्क्रिप्शन में दी गई है। आप हमें सभी सोशल मीडिया प्लेटफॉर्म पर फॉलो कर सकते हैं। ट्रेडिंग और इन्वेस्टिंग में मार्केट रिस्क होते हैं। इन्वेस्ट करने से पहले अपने फाइनेंशियल एडवाइजर से सलाह लें।
इन्वेस्टमेंट की सोचें तो ट्रेडिंग जीनी के बारे में सोचें। अपना भविष्य सुरक्षित करें। आज ही अपना डीमैट अकाउंट खोलें।